If you want the 3 signals that could decide Bitcoin's next 2 weeks, you're in the right place. Gold just printed fresh all-time highs, and Bitcoin is still holding the low 90s. And in Washington, the first real US crypto rulebook is finally taking shape. Here's the tell most people miss. Gold has outperformed the S&P 500 for 6 consecutive months. That's the longest streak since the global financial crisis. This is not a trade. It is capital repositioning into assets that do not rely on discretionary permission. So today, I'm giving you the only map that matters for the next 2 weeks. The levels, the flows, the policy triggers. By the end of today's video, you'll know exactly what to watch. When the setup says lean into risk and when it says stay defensive. So let's begin. Gold is signaling something important. Gold does not make new highs casually. It moves when markets start pricing uncertainty that cannot be modeled cleanly. And right now, that uncertainty has 2 clear sources. First, policy pressure is bleeding into the Federal Reserve narrative. There is renewed legal and political attention around the Fed and Jerome Powell. You do not need to take a side to understand the market impact. Markets care about one question only. Is policy being set calmly, or is it being influenced externally? When traders even begin asking that question, hedging behavior follows. Because if confidence in the referee weakens, capital moves towards assets that do not require a referee at all.
Good evening. On Friday, the Department of Justice served the Federal Reserve with grand jury subpoenas, threatening a criminal indictment related to my testimony before the Senate Banking Committee last June. That testimony concerned in part a multi-year project to renovate historic Federal Reserve office buildings. I have deep respect for the rule of law and for accountability in our democracy. No one, certainly not the chair of the Federal Reserve, is above the law. But this unprecedented action should be seen in the broader context of the administration's threats and ongoing pressure. This new threat is not about my testimony last June or about the renovation of the Federal Reserve buildings. It is not about Congress's oversight role. The Fed, through testimony and other public disclosures, made every effort to keep Congress informed about the renovation project. Those are pretexts. The threat of criminal charges is a consequence of the Federal Reserve setting interest rates based on our best assessment of what will serve the public, rather than following the preferences of the president. This is about whether the Fed will be able to continue to set interest rates based on evidence and economic conditions, or whether instead monetary policy will be directed by political pressure or intimidation. I have served at the Federal Reserve under 4 administrations, Republicans and Democrats alike. In every case, I have carried out my duties without political fear or favor, focused solely on our mandate of price stability and maximum employment.
Second, Iran risk just moved from abstract headlines into explicit policy threat. This matters. A public tariff ultimatum was issued. Any country conducting business with Iran faces a 25% tariff on trade with the United States. That is not speculation. That is stated policy intent. And here is the key transmission channel. The majority of Iran's oil exports flow to China. So pressure on Iran trade is also pressure on global energy flows and the world's largest marginal buyer. That is why markets are treating this as a real risk input. When stress like this enters the system, capital behaves predictably. It moves towards neutral stores of value. And that is why gold is staying elevated. And this is where the transition begins. Gold usually moves first. It is the oldest hedge. Bitcoin tends to follow once the narrative firms up. So the question becomes, is Bitcoin building support while gold leads? Yes. And the answer is visible in the flows. Bitcoin has been frustrating. Choppy price action, false starts, failed follow-through. But structurally, Bitcoin is doing something constructive. It is absorbing supply. Over the past week, roughly 454 million exited crypto funds as rate cut expectations cooled. That typically creates downside pressure. Yet, Bitcoin continues to hold near the $92,000 range. Now, here is the important update. We have likely just seen the largest liquidity drawdown in spot Bitcoin ETFs on record, with more than 6 billion exiting since the October 2025 high. And here is the detail that matters most. Flows have stabilized on average over the past 2 weeks. That matters because liquidity is thin. ETFs act as the marginal pressure point. When selling slows in that environment, it changes the balance quickly. At the same time, a major buyer stepped in. Strategy, we see, added roughly $1.25 billion worth of Bitcoin around the $91.5 thousand zone. That does not mean price accelerates immediately. It means distribution is shifting toward holders with longer time horizons. There is one more observation worth noting. Bitcoin demand is increasingly global and reactive. When confidence in local systems weakens, Bitcoin demand can accelerate quickly. Recent price action tied to Iran headlines reinforced that dynamic. So whether you treat it as an anecdote or a signal, the message is consistent. When trust fractures, Bitcoin becomes a release valve. So let's get precise. 94,000 is the pivot point. Bulls need a clean break and sustained hold. 91.5 matters because size buyers defended it. 84,000 is the line that defines risk. Lose it with volume and downside opens materially. Now here is the hinge for the entire setup. Compression resolves when a catalyst forces positioning to change. And that catalyst is coming from Washington. This is the quiet catalyst that can turn stagnation into trend. Institutions do not need hype. They need legal certainty. And this week, crypto enters a critical phase in Congress, a Senate Banking Committee markup of the market structure bill. This is step one, not final passage. Markup is where amendments are introduced, resistance surfaces, and bipartisan viability gets tested. It is where a bill either proves it has oxygen or stalls out. Separately, the SEC chair has already framed this week as a meaningful moment as Congress advances towards formal market structure. Then there is the second pillar. Code is not custody. The Limis-Wyden proposal explicitly protects non-custodial builders. That includes developers, validators, and infrastructure operators who have never taken possession of user funds. If that principle becomes codified, it keeps innovation domestic, and that is how adoption compounds over time. One additional geopolitical wrinkle reinforces the same theme. The SEC chair has also stated it remains unclear whether the U.S. would seize Venezuelans' Bitcoin's holdings, estimated at over $60 billion. That kind of a statement underscores why self-custody and regulatory clarity now matter at the sovereign level. Now let's zoom out, because the real payoff is not this month. It's for the whole year, for this whole year, 2026. From a macro perspective, this starts to align. Large institutional shops are framing 2026 as a renewed risk-on environment, and I believe that strongly, driven by clearer policy direction and a more constrained rate path. Gold is increasingly being treated as a structural monetary asset again, supported by central bank accumulation. And at the corporate and platform layer, crypto integration continues quietly. Coinbase closed last year with S&P 500 inclusion, EU-wide licensing under MiCA, and over $1 billion in crypto-backed lending. This is no longer a fringe market. This is financial infrastructure being formalized. So let's bring it back to what actually matters, and that's signals. Let's keep this simple. Signal number one, Bitcoin reclaims $94,000 and holds. That is your green light. A sustained hold opens the path towards the high 90s and low $100,000 mark. Continued rejection keeps conditions range bound. Signal 2, ETF flows remain stable. After record drawdowns, stabilization supports base formation. A renewed acceleration of outflows combined with structural breaks is not something to fight. And signal 3, gold stays elevated even as headlines cool. If gold holds highs during periods of relief, the hedge bid is structural, and that reinforces Bitcoin's store of value role. Invalidation is clear, a decisive break of $84,000 on heavy volume. If that happens, you step aside. No forcing trades, You wait for the next structure to form. Here is the through line. Gold is rising because the market is being reminded why stores of value exist. Bitcoin is holding because demand is stronger than price action suggests. We all know this. And Washington is finally establishing the legal framework that allows larger pools of capital to engage confidently. And the Iran tariff threat matters because it is real. A 25% penalty tied to Iran trade, with most oil flowing to China, is precisely the kind of pressure that keeps safe haven demand persistent. You do not need prediction. You need discipline. Watch the signals. A clean $94,000 reclaim, stabilizing flows, and gold staying bid. If this helped you, please like, repost, and turn on the notification bell. It genuinely supports the channel. It definitely encourages me. I love you guys so much, and I'll catch you here in my video tomorrow. Take care.